Good morning, everybody. Welcome to the Armor Investing Way. We're running a virtual hedge fund together. You're the portfolio manager on the desk. So morning meeting, I'm going to share with you my thoughts. You figure out how they fit into your risk tolerance. You're the risk manager of your own portfolio. Figure out what your goals are and then take the information, make it your own. Bottom line, risk monitor's red. So we're in a large cash position and we're looking to really focus on our whiteboard and get ourselves ready for the next cycle. That's the important point of where we're at today. So I'm spending a lot of time during these moments in time. Markets follow cycles, right? There's that risk on green cycle. That's the time to put a lot of risk on. Figure out, and you got to already know where you want to put the money. You can't be trying to figure it out, right? So you know where you're going to go, risk green, put the capital to work. Then the thing starts moving and you're managing your success, raising your stops, booking profits along the way, whatever you're doing. Then you get to this risk monitor red scenario where you're in a max cash position, whatever that means to you, right? You're the portfolio manager. Max cash to some people is 25% cash. All right. Do what you want, right? Other people, it's 100% cash. But what the risk monitor red is really telling us is that there's just no confluence in the market. And when there's no confluence, it becomes very hard to sustainably build net worth. You'll step on one name that goes up a lot, next name craters. And so what you see is a lot of this going on. And so at that moment, when there's no confluence, and that can lead to confluence on the downside, right? That's the time to be working on the whiteboard and getting yourself ready for the next cycle. Let me give an example of what I mean on no confluence, just in a microcosm, okay? This is Tidewater earnings announcements, right? So first of all, we trade around the core. We've already booked a profit up here if we needed to, so that we could buy weakness after the earnings number. That's how you trade around the core. So when we buy it down here, it runs up into earnings. We book some of the profits. If it sells off on earnings, it gives us a shot to add back cheaper. Okay, so Tidewater is down 7% on earnings. Now, I think Ares has got it right. We can look at the numbers, see what they're doing. The numbers on the face of it, the market doesn't like us, down 7%. Well, really, it's up a lot in front of the number. So anything that's not a blowout generally leads to some selling. That's just how the market works. In this particular case, costs are up a bit as they're repositioning some of the rigs so that they can grab higher day rates. So ultimately, it's accretive to earnings. It's going to be a good thing. And my guess is this will be a shakeout that'll give us a chance to add the other part of our position back so we can trade around the core. If Tidewater stays above the stop or stays above the 50-day moving average, depending on what you want to use, 50 days the black line, this is the stop. It comes down, it finds support, it reverses. I'll look to add my position back. Okay? This is precisely what we did in FTI. This is the down day in FTI. We sold, it ran up 3 days into earnings. We booked some of our profit. It sold off, didn't go anywhere, added it back. Right? So I'm just looking for the sell-off. I could add it back the next day. I could add it back a couple days later. We don't know. We'll see how Tidewater is behaving, and we'll look for the next entry point to add it back as long as it stays in the uptrend. On the flip side, we've got DO. DO's up 5.5%, right? So here's the pennant it's forming, and it's going to be up 5.5% on earnings. Now, I've already cut this position down in front of the number. So if it breaks out today, guess what? We're going to increase the position size. Great. Breaking out of a pennant after the earnings number, already booked part of the profit higher, and I may be buying it back where I sold it. I don't mind. I'll buy it back a little bit higher than where I sold it. I don't mind. I'm managing risk, booking some profit, taking it off in front of the earnings news. If it comes down, I buy it cheaper. If it goes up, that's fantastic, and I can always add more if I want. So that's how we trade around the core. But let's go down the process of looking at more confluence issues. Here, just looking inside the top 7 names in the market, right? So you got a couple of charts that just look god-awful, right? Apple's just cratering off of its high, and that looks really bad. I mean, that looks like if you go back and look at the double top, so it tried to make a new high, and it's just getting whacked after the earnings number, okay? Tesla, loses their CFO. the guy who was supposed to be next in line to take over for Musk if something happened to him. So he's out. That's probably why he's out. Anyway, so he's out. That does not look very good. And Microsoft is struggling to maintain the 50-day. So look, these are part of the big guys. It doesn't look very good. But then I can also show you, Google, that looks really good. Amazon looks really good. And Meta, right? So, and Meta looks great. I mean, we sold it in front of earnings, and now the stock popped up on earnings. Could buy it back right here. It's in this unbelievable uptrend. So I'm just sharing these ideas with you because you could see even in the top 7, some don't look very good, and the others look like they want to push higher. We're in a market where there's no confluence. So time to take a break, be patient, raise cash, and get ready for the next cycle. So how would I get ready for the next cycle? This is what's at the top of my whiteboard. And you can just look at charts. First of all, we're going to go over Monster in a minute, but that's a sick reversal of a double bottom off of the 50. I don't want to steal the thunder. I'm going to go over that in a minute. But take a look at Goldman Sachs. Take a look at Boeing. Take a look at Deere. Take a look at Caterpillar. Right, what you're looking at right now is you're looking at a whole bunch of Dow stocks. The Dow chart looks great. Money's rotating into the Dow. So my whiteboard is full of Dow names. And quite frankly, and I'm going to get to this in a minute, there's a real, I spent a lot of time thinking last night of how I want to run my money. And I'm going to share with you some information, and then you figure out, at the very least, I wanted to make you think. Think about what you're doing and how you can improve it. That's the time we're in right now. Risk Monitor Red. It's a time to reflect, go back and look at the last cycle, the last upswing. What kind of money did you make? Did you make the money you wanted? Are you beating a benchmark of what you could have done with the capital? In other words, opportunity cost of money, and get yourself ready for what do you want to do next. Okay. So the Dow looks really good in here. I could buy all of those names, or I could, if I want, go out there and buy DDM, which is twice the performance of the Dow. Twice the performance. If you want to be real aggressive, I could buy UDOW, which is 3 times the performance. Now, what I ask you is, which of those companies, Deere, Caterpillar, Goldman Sachs, Boeing, are going to triple the performance of the Dow in the next upcycle? How about just double? Let's not even talk about being overly aggressive. Which of those stocks is going to double the performance of the Dow in the next swing cycle? I don't know either. I don't know either. So there's a real decision to make. I have a macro portfolio. I've got a growth portfolio. And the question I pose to you right now is of the very real thought that I'm having, that my macro portfolio should be index, double the index, because I like a little bit more risk, but it could just be the index, but double the index, and specific group ETFs. So I submit to you, I'm considering having one portfolio using probably double or triple, because I like the extra performance. And because I have 0 individual stock risk, I could take more risk by improving my performance with doubles or triples. So if I love semiconductors, I'm going to own SOXL, triple the semis. If I want to own biotech, I'm going to find a way into biotech. I don't. I'm just saying to you. If I want to own energy, I'm going to find my way into the big ETFs. And I'm going to own the indexes, the double or triple indexes. And let me show you why real quick. I posted this for you in the Slack room, and I'm just going to share it here on the screen. Okay. I don't know if you guys can see it. All right. Well, I'll just read it out to you, because that's just a whole bunch of letters, and I don't think you guys can see that well. So let me just read it out to you. Okay. We're looking at the S&P in here. Let's just go over this for a second. For somebody who is following the index only portfolio. So It's the simplest of strategies. It strips out all of the noise, and all it does is execute based on the risk monitor. When the risk monitor goes green, we buy an equal weighting of the 9 indexes that make up the risk monitor. We have algos for all 9. We look for confluence across the board. When we get it, we put money to work, and the risk monitor goes green. You can find it on the website, risk monitor, boom. It's very simple. Up goes the green stoplight, and so you know, hey, it's green. It's time to put money to work. Boom. That portfolio puts all 9 in on an equal weighted basis. Okay. So back here, when the risk monitor went green, right here, equal weighting. And right here, when it went to red, so we can clearly see what happened from here to here over the 2-month period on a close to close basis, just to make the execution simple. It doesn't even have to be anything more intricate than that. Okay. The performance of a portfolio that did that was up 6.69%. 6.69%. All you're doing is buying the indexes, no individual stock risk, swing trading the indexes, using the risk monitor, up 6.7%, let's say. And of course, if you're using double the index, so in this case, there's 2 ways that I express the risk, the index only portfolio, right? I always share with you the 9 indexes, and here's how it looks, and this is the returns. Okay, like last year, we only had 2 risk monitor greens. One was a break-even trade. The other, we were up about 5.4%. That was it. The rest of the time we sat in cash. That's what that portfolio did last year. Great year. So let's go look at what's happening now. We have a run of 6.7%, and it goes back to cash. Or we could just trade double the indexes. So SSO, the big indexes, just SSO, QLD, EDM, UWM. Okay, we could do that. Had we done that, just to read it off for you, that's a 13.5% return in 2 months. 13.5%. I share these numbers with you because if you look into your portfolio and it's not up somewhere between 6.7 and 13.5% in the last 2 months, something's not being done right. I have the issues. It depends on how you're running a portfolio, how you're putting things together. So I look at all my portfolios and I look at what I'm doing in my portfolios and I ask myself, if I have a portfolio that's not making that kind of money on a conservative basis, it should be making at least 6.7% in the last 2 months. And on an aggressive basis, 13 and change. If I'm not doing that, then I have to really rethink my execution strategy and what my goals are, right? Because I could do it just following the risk monitor. It gets 100% long at entry. This is the key. It goes to 50% cash when the risk monitor goes yellow, and it goes 100% cash when the risk monitor goes red. For the sake of this conversation, I've taken out the yellow phase because the returns would be even higher. So all I'm showing you is close to close, green to red. But we cut the position down a couple days earlier at higher prices. So the returns are better. So I'm just showing you simple close to close, green to red without the yellow cutting of positions 50%. Okay? For the sake of this conversation. So here are some thoughts that I had for you as I thought about it. My own execution. Some portfolios, I'm in that realm. Other portfolios, I'm not. One factor that's incredibly important that sets this strategy apart from others is that 100% of the money gets put to work day 1 of the risk monitor green. And all of the noise is squeezed out. There's no changes to the portfolio. There's no reducing. There's no booking. There's nothing until it goes yellow or red. You have to live through the swings and the noise of the market. So it does a wonderful job of reducing reducing execution slippage, right? The second thing that it does, obviously there's no individual stock risk. So if you put together a portfolio that has some blow-ups in it, your returns aren't going to be as good, right? So, I mean, of course, the flip side is you put together a great portfolio, your returns are higher. But I'm just saying there's no individual stock risk. It puts all the money to work day one. It doesn't have any wiggles. It doesn't care about the noise. It just waits for the risk monitor to change. And here's the most important key. When I look at my performance over the last couple of months, and I'm asking you to look at yours and think about this, right? It does not reinvest cash at higher prices, right? It puts all the money in at day one and takes it out when the risk monitor turns red. So what can happen in a portfolio is you put together a portfolio in the first week of risk monitor green. Maybe it takes you more than one day to put the money to work. So you're missing some of the move, right? Then a couple positions blow up on you. So you take a loss and you go reinvest the capital because the market's going up. But now you're putting money to work at higher and higher points, further and further away from the real entry point, which is more and more risk. The further away from the entry point, the more risk. Now, in a rip-roaring bull market where the Fed is using a fire hose to add liquidity, you can get away with that. And your returns might even be better. They might be better because you'll reinvest at higher levels at the next great idea and you'll hop on a huge winner and the portfolio will perform. But we don't live in a world where the Fed's using a fire hose every day, right? So we have to execute a strategy that works in all environments. And this is what I wanted to share with you this morning. Look at your portfolio. Look at the performance of the last couple of months. The market's going to give you another opportunity. How do you want to put the money to work? It can be a partial allocation just to the indexes. Get yourself close. Risk monitor goes green and some of the capital gets put to work this way to give you balance, right? You'll capture that upside. You won't be constantly reinvesting the whole portfolio as it goes up because you're not going to move that portfolio, right? So you're going to get the balance there. And then the rest of your portfolio, you can try to hit a home run with the right investment ideas. So it's up to you how you want to take the information. You may look at me and feel real pleased with yourself right now because you crushed it in the last 2 months. And you got nothing to do. Your execution strategy is great. But I wanted to share these thoughts with you because we're at that phase in the cycle. Risk monitor red. It's time to look at your strategy, look at your successes, the failures, things you'd like to do better, because the beauty of the market is it always gives you another opportunity. Okay? And then my last thought this morning is just to look at Monster Beverage. This is a sick chart pattern, and I really appreciate Brian T. I'm going to call you out for consistently bringing this idea up to the ARMR trading desk, okay? Because this is one of the best chart patterns I think you're ever going to find. This is a classic reverse head and shoulders pattern. Shoulder, head, shoulder. Breaking of the neckline was a pennant formation. This is the early entry point. This is the right entry point here in late March, early April. It ripped higher. Now it's pulled back, right? And had a perfect shakeout below the 50-day moving average. Perfect shakeout. This was an earnings announcement that put the stock down and the very next day closes above the high. That's a classic 3-bar reversal. Look down here at the MACD. This is a simple indicator. Anybody can use this. I share this with all of you. This is a basic MACD right off the shelf. Nothing intricate about it. But it's one of my favorite setups, which is a double clutch, I call in the MACD. I call it a double clutch. It gives you what looks like a great turn, right? It broke out here. So there's the downtrend in MACD, and then it pops up. That looks like a great buying opportunity, right? But the better buying opportunity is when this one fails and it immediately reverses back higher, making an uptrend in the MACD, a higher low in the MACD, a double clutch. That's the double bottom. That's a 3-bar reversal on a candlestick. That's like a classic candlestick 3-bar reversal. And my last comment to you, we'll have to cover this more on the live desk. We'll keep talking about this. It's very important about execution. I'm adding this to the ARMR day trading playbook as part of our execution strategy, so you understand how to put money to work on a day trading level, but also on a swing trading and investing level. There's a locked and loaded day, and then there's the buy trigger. It's not the same day. It's not the same bar, 3-minute bar day trading. So what I mean is this. You get the reversal. You don't have to run out there and buy the reversal. Very often reversals get reversed, right? You get false breakouts. So this is the locked and loaded bar. And what you want to do is buy the next bar that takes out the high of that locked and loaded bar. That's the buy trigger. So anywhere up here is going to be the buy trigger. It can happen today. It can happen 3 or 4 days from now, whenever it happens. If the low of this bar is taken out, that's your stop, because that's clearly the 3-bar reversal. So takes out that low, you're done, right? Once you get long and it breaks out, then you raise your stop to the low of the bar you got long. I don't know where that's going to be. It could be somewhere in here. Like, in other words, it could be down today, but breaking out tomorrow, and then the low of that bar would be the stop. You follow me? If I get on it this morning and it rips higher, I'm going to use the low of this bar if I get on it right close to the high here. You see what I'm saying? But that's how to execute. That's how to execute. There's the locked and loaded bar, and then it's the next bar that takes out the high of the L&L bar. Okay, so it's at the top of my whiteboard today, and I'm going to get on Monster if it sets up. We're going to see. Markets are opening pretty, they're giving up all yesterday's gains. They're opening up down 1% roughly. Treasuries higher, dollar higher, concerns about what was going on in China overnight in the sense of their economy continuing to roll over. I saw another big real estate operation in China. Looks like it's going to go under. So here we go again. So that's going to drive money into treasuries. Not a bad thing. It's going to drive money into U.S. dollars, but that's generally a negative for equities in general. So, you know, it's funny. Treasuries are first of all, we don't want treasuries to keep imploding. So the fact that they're up today is a bonus. Okay, they've been totally imploding. So maybe they make a double bottom. Maybe they rally up here. But there's 2 reasons treasuries go up. Risk off is the trade. So equities are getting destroyed and money's funneled into long-term bonds on fear. And we know that's happening when treasuries are going up, the dollar's going up, equities are selling off. That's the fear trade. Okay. And that's what's happening this morning. The more friendly for equities treasury trade is when treasuries go up because rates are coming down and the market's going up with it, having nothing to do with a fear trade. But this morning it's a fear trade. And so we'll just have to see how long this plays out. Okay. But anyway, those are my thoughts for you this morning. I hope you found them helpful. I look forward to working with all of you 9:30 on the live desk. And we will be covering the Monster earnings conference call. I really want to hear this. What created this great reversal here? I'm going to cover that call at 12:30 on the live desk. So anybody that wants to be part of that, just join us 12:30, and we'll listen to what they had to say, and I'll likely put a trade on if it takes out the high of yesterday, which is the L&L bar. All right. Have a great trading session, everybody. Oops.